Hi, Liana. How you doing?
I'm good, thank you. How are you?
Good. Thanks for coming on.
Thank you for having me. So, it's been a huge week, and diving right into it, I wanted to ask you what you think of DeepSeek.
Look, DeepSeek came out, over a week ago now and had a pretty big impact on the markets. Nvidia on Monday had its biggest one-day loss of any stock in history. And it was probably quite valid. I mean, the headline was that DeepSeek spent 6 million US to train their model, which is obviously a fraction of the capex plans of other companies. I mean, Meta just reported, and they're still planning to spend 60 to 65 billion um, this year. So you're talking like four orders of magnitude difference. Now it was a bit cheeky of them because they're not including the hundreds of staff that they apparently pay the highest salaries to in China. And they certainly did have a lot of Nvidia chips. This was originally a hedge fund that was known for having a lot of Nvidia chips. So I think that headline number is a bit misleading, but it did surprise everybody because this was a model that was certainly done a lot cheaper. It's available for free. Um, it's really put into question the business models of companies that are building foundational models and planning to monetize those models directly. So that was probably what was behind it. If you can create a state of the art model for a fraction of the cost, then why are the big tech companies, spending 50 billion plus each on capex a year for the next few years? Like it really raised a question around that.
And for those who don't know, what's the difference between open weight and open source?
Yeah, I mean, open source has been around almost as long as software, I'd say, where people would kind of put their software online, allow others to use it, improve on it, commit code. If it was approved by a community, or probably in reality, a community leader, would then improve the product for everybody. And there's a ton of the world that's, built on this. It's all around the Linux community. Most servers use Linux. But this is not an open source model. So we don't actually know the code they used or exactly how they did it. So they have released some papers, they have given some information on it. What it is, though, is it's open weight. And the reason that's interesting is because it means that it really is in the free domain, in the public domain. We might not know exactly how it was trained, but anybody can host it. If you have a big enough or powerful enough desktop, you can download the model, certainly smaller versions, and use them, for free. Or you can host them on AWS or Microsoft Azure, and it's extremely effective. And that was kind of interesting because there was also a bit of controversy around the way they trained it. So apparently, it seems that they were using OpenAI's model to train their own, effectively to check results, to create synthetic data, and really improve their own model. And so what that means is that models can be used to improve other models. And once a model reaches a certain level, if they're allowed to, or certainly if it's open weight, everybody else can use that model to increase the power of their own. And it was kind of ironic because OpenAI didn't seem particularly happy about that. But of course, OpenAI scraped the whole internet's data without really asking anybody's permission, including every published book. Again, without asking authors' permission. So it's a bit hard for them to come out and complain about this. But what it does mean is it's public domain. This is an asset for the rest of humanity forever. This is a level of language models that's now available for free. And, we're not going back. Like, this is public domain.
What does this mean in terms of distillation and mixture of experts?
Yeah, well, mixture of experts means, you kind of, you train one model to, say, answer math problems, another one for coding, another one for more typically language tasks, and then use a language model to try and figure out the best one. And that's how you can get really, really good performance in those particular domains. It also means even though the model itself was, I don't know, 670 billion parameters, which will only fit in the largest computers, at any one time, it's probably only 37 billion that are being used. And it's really fast. OpenAI uses this. It was a really interesting method. The distillation one, it's hard to know. We don't know what's happened, but we do know that OpenAI is confident they have evidence that they were using their API data from their model to train their own. And it does really, open questions about the defensibility of these business models. And I think there's basically a big difference in the way that people are doing large language models. I mean, there's companies like Meta, which are going down a similar route, a very open route, and they're not directly charging for large language models, but they are using the community that surrounds it, the advances that come with being open source to improve their own AI. And obviously, their main game is improving their ad spend and generating revenue and profits that way. And so I don't think it really there's definitely clear winners and losers. The losers would be anybody that's planning to charge a subscription for a language model, which is now effectively for free, almost state of the art for free. And you can expect that, the state of the art open weight models will probably be 6 months behind the absolute state of the art, but more or less where they are. They're already extremely good and extremely powerful. It really challenges all those business models. OpenAI will probably be fine. It's the only one, with widespread consumer recognition. It's the only one with a brand that the person on the street's probably heard of. There's a lot of defensibility around that. The more you use it, you can see you can create projects. It's starting to learn more about you. As we go forward, it will absolutely be the case that if you're a subscriber to OpenAI, it will take into account your existing content to serve you better results. There are some pluses, but there's a long tail of language models. Like, where does this leave Mistral in the EU? Where does this leave Anthropic, which is AWS? What's the value of being a fourth, fifth, sixth, seventh best model? And there's a lot more than 7 companies building foundational models. And then I guess what spooked the market was, what does this actually mean for CapEx? Because all these companies are buying, the latest Nvidia chips and spinning up their own clusters. And there's been a mass imbalance between demand and supply. Demand has massively outstripped supply for basically the whole last 2 years. And the question is now, what happens next? With such a good open weight model in the public domain, how can a mid-tier provider justify spending money on it? And these companies are all loss making in that early stage, so they're all reliant on future rounds of funding. So if that funding dries up, and I don't think it's going to dry up, but I think it definitely will kind of consolidate around the very small number of winners, and a much smaller number of winners now that DeepSeek has come out. There's a good chance those companies can't raise the money they need to stay in the game and stay competitive, and there's no reason not to use the best model. So if DeepSeek is the best and it's for free, every user is going to have to take that into account. There's also clear winners. So these models, even though they're free, even though the open weight models are free, they still have to be hosted somewhere. So you still need to put them on AWS or Microsoft Azure or Google's cloud platform or one of the smaller companies. So this could potentially drive demand for those services. And there's another set of winners which I think the market is not appreciating, and that is some of the more traditional software companies. I mean, most of these companies are only 10, 15 years old. But the reality is like with a cheap model, that opens up a lot more use cases. And there's a good chance in the next year or so, those use cases start to take off.
Could you explain the underappreciated software companies, the 10 to 15-year-old ones? You're talking about IBM and Microsoft, things like that.
Basically, all these software companies were restricted by the number of people on the planet. So if you're Salesforce, you can only, like in the best possible outcome, your maximum possible market is everybody on the planet has a Salesforce account. Obviously that's going to happen. There's a certain number of business workers. They can only get a certain number of those that will have use for a CRM. And of those, Salesforce is only one player. But it's always been tied to the population, right? It's always been tied to the number of people with a computer sitting down and doing work. Now, if you can make a sales agent, then that is unrestricted. You could spin up 20 of these overnight, basically for the cost of the additional computing power, which is not for free, but it's certainly a lot cheaper than hiring somebody. And you're really kind of untethered to the population. And that's really the bull case. And it's not just CRMs. Salesforce is probably not even the best example of that. You could argue that perhaps each one of these agents or operators is a security endpoint, and each one of those will have to be protected. Each one of these agents is going to generate a ton of data. It's going to be interacting with other agents. That data would have been previously restricted to the amount that 2 people can generate. 2 people interacting can generate. Now with AIs, with potentially human level intelligence, certainly human level intelligence for specific tasks, you're no longer capped to those market assumptions. They're all going to need security protection. They're all going to generate data. All that data is going to have to sit on a database somewhere. That database is going to be charged for. They're all going to need monitoring. So it's probably bullish for monitoring software. It's really anything that like a knowledge worker would use, 20, 30 subscriptions. that a knowledge worker would use, you could feasibly make the case that a lot of these agents are going to need that as well. And so if that's the case, then the market for software is way bigger than what people are thinking. And you could see that in the market reaction. So in that day when Nvidia was down, I think 17%, software was largely unscathed and bounced really hard the next day, because I think the market's it's just starting to figure out that the opportunity in some of these companies, not all of them, but some of them, is exceptional. And that could be the next leg. There's talk of, well, the race for a good foundational model is getting somewhat mature. Obviously, there'll continue to be advances, but it's pretty clear that there's going to be a handful of people doing it. The middle and lower tier are probably not going to make it. There's going to be very amazing, like cutting edge open weight models available for free, but that's going to spur a ton of usage. And OpenAI has started with their operators, their agents. That part of the demand curve, you're really in the first innings, as opposed to kind of somewhat later on for the foundational model training. So I think that's pretty interesting, and I think it's something we're certainly looking at when we think about what performs well in 2025. There's a good chance that there'll be companies like that, and you'll really only see that in their results in a year or so's time. So the question is, A, how strong is that thesis, and B, how do you act on it? And then it'll still have to be justified by the numbers and the fundamentals as they come through. But I think it's a really, really interesting piece of what's going on right now.
Speaking of spending in the AI space, I did really want to talk about Stargate, which is something else which has been announced.
It was kind of interesting. I think it was released a day after DeepSeek, and it was almost like the first phase. So in the last 2 years, every major tech company has been trying to emphasize how much they're going to spend. As they announce their big spending plans, stock goes up. That's quite unusual. Like if a car company did that, there'll be huge questions around it. And actually, the spend, even for Meta, they released results last night, and they're still sticking by a $60-65 billion capex spend. That's way ahead of what an automaker would spend. It was almost like I wonder if it's the last moment of that leg of the cycle. Particularly because it was Masayoshi Son. So Masayoshi Son was part of it. He's largely missed AI.
And who is that for people who may not know?
Look, he's one of the most interesting investors probably around, because he's made more money than almost anybody, but he also seems to make the dumbest decisions. He's some mix of the best and the worst investor in one person. Like if you backed a random company that he backed, you're probably going to lose all your money. This is the guy that was going to put money to $15 billion into WeWork at $50 billion valuation. This was a guy.
Cool.
Then what's made him successful? Well, he invested in Alibaba. I can't remember exactly. I think it was $15 million, and then just held on to every single share, and just became insanely wealthy that way. He runs SoftBank, which is a leading Japanese tech company, telecommunications company. He's just done a very, very small number of investments, held on to every share, and a very small number of those have been some of the best investments ever made. And that's basically what's been behind it. But he does have this habit of coming in at the top of bubbles. He did it in the tech crash as well. Nearly got completely wiped then, but held on to enough equity to kind of ride through. He did it obviously in 2020, 21. He was one of the leading players that were pushing up valuations. He was writing enormous checks into companies with no moat, many of which, no longer exist anymore. He really seems to come in as like the most aggressive guy and a really long-term guy. But it's kind of interesting because when you think about the investments that worked, I wouldn't say that was the case with Alibaba. That was a much smaller company with a huge opportunity. It's not like he was investing $100 billion into the hottest thing back then. It just wasn't like that. It was really early on. And now he's coming in relatively late into the CapEx cycle, I would say. And, there was a moment 2 years ago when this AI stuff wasn't there. Nobody knew that these chips were going to be so valuable and potentially and so changing to the whole tech ecosystem. That was the moment. That was the moment where it was like, well, we're right at the beginning. There's nowhere near enough capacity to build the chips that everybody wants. And that's why companies like Nvidia went up more than 10 times. Justified by earnings and profits, by the way. It's not actually that expensive on this year's earnings. Now it's kind of different. I mean, the big tech companies are probably not going to grow their capex in 26, it looks like. So they've done these massive capex plans, and now that growth is probably over, there's still going to be enormous annual numbers. But we're definitely past that point in the cycle. And Masayoshi Son's there, waving $500 billion numbers in the air. But remember, that doesn't necessarily, the odds of that actually happening are probably quite low. I mean, the money's not there. It's a much smaller commitment. And then, that's also OpenAI, which I think is probably quite challenged right now. An open source model that's as good as theirs, an open weight model, sorry, is a real challenge to their business model. I mean, I've already started using it. And another advantage of the open weight model that I didn't mention was that you don't have to host it in China. So you don't have to send your data over there. You can obviously put it on your own hardware if you want. I saw someone saying it'll cost about $6,000 to get your own system that will run the full model, and you could do that in the office. We could do it as like a side project, and then nobody could ever take it away from you. You don't have to connect to the internet. It's just going to give you whatever answers you need.
Do you think that gives it an advantage beyond just being free of cost and open weight over other AI available on the market right now, and people are going to want to use that more instead?
I mean, absolutely. I mean, you're bound by OpenAI, right? If you use their model, they can change that at any time. The Chinese obviously have their own biases into it. It looks like you can actually use DeepSeek's model. If you don't host it in China, you can actually get it to answer things, they're politically controversial over there. But there's a huge amount of political influence over OpenAI's results, and that can change. They could scale that up, they could scale it down, they can change the model at will. You're just using their API. You don't have the open weight. It's not a static thing, which is the case if it's open weight. And it's quite serious. You remember there was like that controversy with Google. It's, the kind of politics in the US didn't just seep into controversial moments in the US. It obviously affected politics and what they would and wouldn't say about different candidates. Obviously, much more critical about Republican candidates, much more kind to Democrat candidates. But they also changed history. They also changed the skin color of historical figures in images and things like that. It was really pervasive influence. These open weight models don't necessarily have that. And it's yours to use. So it is a huge advantage to open weight, in addition to being free, in addition to being able to host it wherever you want. It really is a threat to those companies. I actually think all the cool kids will start using the open weight models. I think that's the direction it goes. I think some people use OpenAI and Microsoft because potentially it's more reliable. But you can use these open weight models on Microsoft Azure anyway. I think that the people that really excited and deep into this field are not going to want to use OpenAI. Will have a bias against it, if anything, because of all of that.
ASML reported their earnings earlier this week, and they've doubled their bookings. Their guided earnings for the next year are projected at 46%.
Yeah, I mean, that's a strong number. Again, we're talking about how we're relatively late, certainly a couple of years into this CapEx cycle, and they're still posting, really high numbers. It's certainly something we'll look at. I think ASML is pretty far down the chain, though, because remember, customers like Meta, Microsoft, Twitter, they're the ones putting in purchase orders for Nvidia. Nvidia's then using capacity at Taiwan Semiconductor, and Taiwan Semiconductor is then deciding how many lithography machines I want to buy from ASML. That's kind of like the chain. So for the customers, if the cycle turns, what will happen is a few companies will stop getting funded. That already has probably started happening last year. There'll be excess capacity of Nvidia chips. They'll then go on the market. You'll be able to see the secondhand price of those chips fall. You'll see the cost to rent those chips fall. This has all happened multiple times in the last 5 years. The cycles have been really short, really fast, and then that will infect Taiwan Semiconductor. They'll then make less, and then they'll order less from ASML. So ASML is going to be a very lagging indicator in this, but it's also the good thing about ASML is so far it's the only company that can do it what they do in the West. I read a few times that the Biden's decision to, and it's probably more than Biden, it was probably the US establishment's decision to restrict Chinese access to the leading chips was a huge mistake. The reason for that was the Chinese are going to do it anyway. And it's better that they just buy Western chips, because then the revenues and then the profits and then the increase in capital on the balance sheet, that happens in Western companies, which can then maintain their lead. And if there was some kind of hostile conflict, you're much better off having big, strong Western companies, dominating that industry.
So the fund ended the year up 56.5%. Walk me through how 2024 went.
Yeah. I mean, it was the two halves were completely different, almost exactly like at the 6 month mark. It was like the first half of the year, everything seemed to go right. Aussie biotechs were ripping with companies like Clarity. We had a number of our classic, explosive growth, true customer love stocks. They all pushed to new highs. And then we made semiconductors like our core position as well, and all of those companies did well. Around June, there was like a changing regime. What happened then was there was the semiconductors kind of topped then, and other than Nvidia and perhaps Taiwan Semiconductor, the vast bulk of them sold off significantly. And also there was a huge number of reversals in those medtech, explosive growth, true customer love companies. There was so many. It was like, whether it was in Australia with Drone Shield, whether it was Celsius, Elf, TransMedics, there were a number of companies that dropped 50, 60, 70%. And we're kind of lucky because, we've been working basically using these AI models to build risk systems that basically flagged all that stuff pretty early, and allowed us to exit those positions, which meant that we still ended the year, I think we were top 3, top 5 in Australian fund managers, depending equity fund managers. So that was pretty positive. I feel like we're playing defense for 6 months, which is a lot less fun than when everything is going up. But it was a real proof of concept because we monetized some huge gains, like 150% plus gains in companies like Drone Shield and TransMedics that then ran into trouble. And I think if there's one thing we learned over the last 5 years is that the downside in these really ultra high growth stocks, it's not 30, 40, 50% like it might be in a bank or an industrial company. When they reverse really fast. And it does seem like, a lot of people have been saying it does seem like the market's moving a lot faster these days. There's whole cycles within a year. And I do think, I do have a feeling that like things like Twitter, things like the much more easy access of information, the rise of day traders, of Reddit, of options trading, all that kind of stuff really magnifies it. So when a stock kind of captures the imagination of a market, it might double, triple, quadruple, and then the next 10 years of success becomes baked into the price. And then as that starts falling, all those price-based, momentum-based investors one by one kind of drop off. And what you can do with the way we're approaching now is we really want to harvest those gains and still be long-term investors in these companies, just only at certain times. So, we went through every stock that we'd owned pretty much, and realized that if we had sold things that went up 4x, would have dramatically outperformed. And if we sold things that went up 2.5x, would have dramatically beat the market, performed a little bit less well, but significantly reduced the volatility. And we've seen that multiple times last year around that 2.5x mark, where companies had those moves in 3 months and then reversed partially or even fully, in some cases ending the year down. I'll give you one interesting example. You'll know TransMedics well because we talk about it all the time. We've been doing a lot of work on it. But that was a company that was 100% plus grower, really exciting medical technology, helping people transplant organs. Clearly better than the standard of care, which is a bucket of ice if you're moving an organ around. Much better to have that warmer and having the right fluid going through it and monitoring its vital signs so the surgeon can make a better call when it comes time to decide whether to use that organ or not. Obviously, they're very critical decisions. The patient's all ready to go, and then the surgeon has to basically decide whether to cut up their liver and replace it, or heart, or something like that. So it was doing really well, and then it decided to buy aircraft to basically own the whole kind of process. So use their own surgeons, their own expertise, and their own transportation rather than making use of whatever flights were available. And there's definitely sound logic around that. What happened was, it does seem like they then took that and then ran with that too far. So it was a short report, it was one of those 100-page plus reports. We did a lot of work. We spoke to a lot of experts that have very positive things to say about TransMedics and why they use it. They obviously found some people that had negative things. But the main negative thing they said, the core of the allegations, on top of the little things like the CEO seems to have, was driving around in black SUVs and convoys to go to conferences and things like that, which obviously winds all the doctors up. But the real core is that it doesn't seem like there was a cap on the amount that they could charge the Medicare system and the health system for transportation, for the whole organ process. So they would force or kind of strong arm the hospitals into paying not just 100,000 for the use of their device, but maybe another 40,000 US for flights and transportation, and forcing them to use their own staff and use the whole end-to-end process of TransMedics, and then basically bill that to the end payer, whether it was an insurance company or a government payer. And there was no cap on that. And so TransMedics was kind of like quite proudly saying, look, these things are uncapped. We charge, and then, we get paid. But there's plenty of people who think that actually, that if the hospital can find a cheaper plane and they have a young surgeon who's happy to go out at 3 a.m. To some rural site that's near a car crash, they should be allowed to do that. And it does seem like TransMedics may have pushed it too far. So the crash kind of this was one of those ones that was up, I think, 2.4x, like 140%. We sold a good chunk of it then. Again, it's kind of system-based. And then they had their first quarterly decline, and then the short report came out. So we exited the position entirely. Short report came down, it dropped another 20-30%, and we protected that last bit. Even though, like, over that year, over 2024, I think it was one of our, other than semis, it was our biggest contributor, and remained that because we'd cashed the profits. But now the earnings will be really interesting now, because it's become one of those stocks where the short interest is 28% plus. So if it does reverse, then it'll be kind of like Carvana was when the short interest went sky high. Everybody's just going to have to buy back in higher prices. It doesn't, if there's any operational turnaround, if they return to growth, then all the short sellers are going to have to buy back at higher and higher prices. There's no need for any additional catalyst other than that. But it's a good example of how realizing profits made sure that we had a really profitable trade. It finished the year down a lot. I think it was down like 20% or something like that. And then as it was falling, we then closed the rest of the position, again using risk modeling. So it's a good example of how that works in practice. But there are many others. Like Celsius is like a kind of energy soft drink. Love it. Used it when I was in the United States. Extremely popular. I mean, they have like a kick. It's like an orange juice and a very strong cup of coffee all at once. But, sales have kind of stopped growing. And this was like a red hot Twitter stock, I guess you could call it. So it reversed entirely. That's like down over 70% now. So if you held that, if you're like, I've got a long-term view, Celsius is amazing, the growth numbers are great, you'd been stuck in that fall, whereas we got out like relatively close to the top. And there were so many examples of that in the second half. And
Who were your biggest winners and losers of the year?
the biggest one was actually in semiconductors, where we realized a 4x profit, and we kind of closed it out in around June. TransMedics was also up there in terms of biggest contributors. We had Clarity Pharmaceuticals, so we bought a big chunk at $1, put even more in their cap raise, around 250 plus cents. I think our average price is almost exactly $2, and then it went to 8 really fast. And then we sold some, not all of it, and then now it's more than half since that point. But that was still one of our top contributors. But it wasn't just that. Actually, Aussie Biotech was extremely good for us. I mean, we had an advantage of these models is you often realize that you often end up making big sells, and all of a sudden you've got all this cash, all this like capacity to buy something else. So looking around opportunities, we found OrthoCell, which was rolling out in the United States. That went up 2.5 times. We invested in EBR in their capital raising. They're doing like a medical device that goes in the heart. That went up more than 2.5 times in the second half and into this year. So we found other opportunities. And then there was also Syntara, which was one of our larger contributors. So we'd invested in this for a while. It was one of those companies where nobody knew. You go out to the facility in Sydney, and they're just so happy to see you. They'll take you around for a couple of hours. It's very hard to leave. Just want to, okay, now we've done the tour, let's go to the boardroom and have a chat with like everybody. It was really, nobody had any interest, and it was very kind of technical story. It's targeting, a disease that not many people know about, that doesn't really has a treatment, but it's not disease modifying treatment. So there's immense unmet need. And they did have trial. It was the second phase 2. So they did have data that showed that it worked, and very good preclinical data. And the other thing that was interesting about it is they do all their own chemistry in-house. And in Australia, there's a lot of companies in the biotech space that are repurposed drugs or reformulated existing drugs. And these companies typically go for the orphan drug designation. So they do get some patent protection there, but it's actually quite short. And that the length of the patent protection, directly impacts the amount that anyone's going to pay for it. So it really affects the value. And also sometimes those things come under often they're scrutinized in the courts later, because there's a number of very well-funded generics companies that make it their business to go out and they'll scrutinize drugs that have developed a market. So you can do all the work, all the approvals, get there, and then be challenged in the courts. And I've actually seen that happen a number of times, and at least once in a company that we owned. And it turned out that the courts decided that actually the IP wasn't that strong, and the drug could be sold for free. And that obviously completely wipes out the value. And that's their business. That's what they do. They're scouring. It's not like some random thing. They're scouring the market for these opportunities. If you have composition of matter, if you design the drug yourself, if you made it, you're the first person to use it, then you don't have those problems. The IP position is much stronger. And also the way they did it is you don't have to necessarily publish. You don't have to tell everybody what you're doing, what you've got until the right moment. So if you've got if it's going to take you 5 years to get to market, you can be really strategic about the time at which you want to file that patent and extend it further, which obviously, pushes out that final date. So Syntara did that very well. It was a messy company as well. They had another business. They had to sell that business. They had a hiccup where the people they sold it to weren't paying them. There was like so much. It was one of those stories where there's so much hair, but also if you actually did the work, an incredible opportunity. And now they came out with extremely convincing phase 2 data. So the rest of that trial will read out in March. They've already probably shown enough that it's worth pursuing. But you never know. Maybe, who knows, maybe at the 6 month or 9 month mark, there's some new side effect that hasn't been seen yet, or maybe patients relapse faster than you'd expect. You never know, but as far as you can know something, the data was extremely strong and the trial was a success. And they'll have to determine what the final trial design will be in the FDA, for their pivotal trial, which will be around June, and probably needs about $50 million US. Depending how they do the trial, it could be more, maybe it could even be less. And it's still a $100 million company with data that suggests, in the United States, transactions at a similar stage for probably worse drugs that aren't disease modifying, and fortunately aren't directly competing either, have been in the billion plus range. So we think that that's a stock in this year that could go up to the $200 to $300 million range. If that does happen, they'll have a lot of opportunity to there are a lot of different financing opportunities available to them, even potentially raising the money themselves, or they could license out. They'll have a lot of different options on the table, and that's something that we can look forward to, over the next 6 months.
On the topic of Aussie biotech companies such as Syntara, which develop their own medicine and technology, they have their own scientific research and backing. Do you believe that these companies are more likely to be successful than the ones that you mentioned who perhaps adopt pre-existing medicines and technologies, especially heading towards later stage clinical trials and international expansion, FDA approval, things like that?
Yeah, I think it's hard. I think, there's a number of opportunistic entrepreneurs, I guess you could call them, who will license in drugs that exist, reformulate them, or try them in a new condition. The good news is that often they work. And there's generally a lot of data. They're really well characterized. The safety. You know a lot about them because they have already been through that trial process for something else. They've generally haven't been good performers in the stock market, and I think it's because most sophisticated investors don't really get behind them for the reasons I said. They know that sure, it could get the orphan drug designation, but that's not very long, and the clock's ticking on that anyway. It's less interesting to a potential buyer. There's legal risk around the IP. The key point about the legal risk around IP is it's only litigated after it's approved, so you don't know. So no one's gonna, if a company's doing expensive phase 3 in Australian company, no one's going to challenge that IP. It's really, no one's going to bother. It's only after it's successful and they start marketing it. That's when the challenge comes. And that's why those companies don't really get the support of investors that, are in the space. Because if you've seen it happen once, you really don't want to have it happen to you again. And it's kind of nice to support companies that are doing their own science, right? Clarity's doing their own science. Neuron brought a drug to market, that was new, that was novel. There are companies here in New Zealand and companies that are listed on the ASX that are doing the hard work in new modalities. And I think that's just the most exciting place to place to play. And even though there's probably more risk because they're less well characterized than the drugs that are licensed in, um, they're probably better commercial opportunities.
So we had a call with CurveBeam. What did you think about that?
It was one of those mixed calls. I mean, the really exciting thing is that the sales have picked up again. So they had their record sales of their device, both through their own sales efforts and also through Stryker. They did a partnership with Stryker, which they basically handed over the sales responsibility to a US company, Stryker, which is a giant in the space. And basically, Stryker kind of needed more data. And so it really pushed out. We're expecting this year to be the year that they would get significant revenues. And actually, it looks like at best it will be, sorry, last year, 2024, and at best it will be 2025. It should be around March that process is complete. But they did get a long way towards break even this quarter. The downside for them is they only have 3+ months, 3 to 4 months of cash. So they think they can reach break even this year, but that's cutting it way too fine. My view is they'll probably have to raise money. I think it's an opportunity if they do. I think that capital overhang is gone. They've demonstrated that they can get these sales, and they're really just scratching the surface of their potential market. We've done multiple channel checks with end buyers. We've done channel checks with like Stryker reps. Everybody's extremely positive about the demand for the product. They just need to do these additional trials. And it was probably a mistake, in my opinion, and I've told the company this, they know that. I'm sure they would agree that it was a mistake to wind back their own sales efforts. Like we invested, I think they're doing 13 million a year of revenue when we invested. Then they handed over the sales function to Stryker. And I've seen that multiple times in small companies and bigger companies that are listed. Never hand over a key function to like a big company. The amount of companies you see that or relying on one company, the amount of companies you see that, I don't know, they're waiting for a big contract from Coca-Cola or they're late stage on something else. Like these companies, they'll just like, it just doesn't, there's so many layers. You're probably 3 or 4 down from the CEO. They have to go through their process. It's not really on their radar. If it's a 6-month process, 6-month process. If you've got the data in and it's a time of year when everybody's away, well, I guess you have to wait until the committee re-meets in 6 weeks' time. And the fact that 6 weeks might be really material if you have, 6 months cash, it doesn't really play into it. It's really risky. And so the company has reignited their own sales efforts. And we'll just, this is kind of a pivotal year for them. Now, the stock didn't respond. It's hard with these companies that are only trading, tens of thousands of dollars a day, because it really doesn't take much to move it one way or another. The big holders invariably hold. Like you can't sell $5 million of stock in this company, whether you wanted to or not. So you can't read too much into the market movement. But I do think that it's a company that will raise. But when it does raise, that will probably be the moment. The same way, there's another company we invested in, Terrace, who did a huge raise, 88 million US. They relisted or dual listed on the NASDAQ. And that overhang, they just announced this 6 months before. And that overhang cut the stock in half. Because why on earth would you buy a stock if you can just get loaded up in a raise? It just doesn't make sense. If anything, you should short those companies into the raise and then put more money into them. And if the capital requirement is large, you will get filled whether the company wants to reward a short seller or not. I mean, we're not shorting these companies, but it does come into play. So I think that there'll probably be an overhang until that's sorted. The best case scenario, they do some kind of strategic deal and they get cash that way that's non-dilutive. So I know they're working pretty hard at that. And I guess the company's extremely optimistic about their sales efforts this quarter. So if they can reach break even, they're running down their inventory. They did 5 mil of revenue of purchase orders and the cost base is 17 mil. So they're pretty close to break even, but it is a capital intensive. I wouldn't say capital intensive, but they have to obviously make the inventory and then sell it and ship it. And so there is a lot of capital tied up in that. They're trying to release that by running down their existing inventory. But if that's one that I don't think the turnaround moment is now, but if there's a capital raise in the next 3 to 6 months, that's probably the moment. And then that could be one of those top performers. That could be an OrthoCell or an EBR or a Clarity or one of these companies that's kind of on the nose and then all of a sudden doubles or triples quite quickly. So that's an exciting opportunity that we're invested in and have been for some time, but this is a pivotal year for them.
Absolutely. And it sounds like a really interesting company to look out for in the next year to 18 months or so, which also reminds me that I wanted to ask what your outlook is for 2025. What are your predictions? What do you expect?
Looks to be interesting. I mean, the United States is in a weird place because there's a huge amount of action going on at the top. It's quite exciting, quite exhilarating to see what they're doing. They're obviously offering redundancies to the entire to every federal employee. It probably will at the margin reduce inflation, right? That's a lot of extra employees in the job market. In Australia, its inflation number was pretty good, so we're still above three, but only just above three and falling. So I feel like a lot of people are under a lot of pressure. You can see there's been real estate falls across the market. And it's just something you can feel. We see it in terms because we speak to a lot of investors. We have hundreds of our own, and speak to many more all the time. And it's just a time where it feels like everybody is quite tight. Everybody took a lot of people bought a lot of real estate. A lot of people did extremely well, but they're certainly paying more interest than they expected. Expenses are higher. Everybody's worried. If you're a kind of, I guess most a typical investor will have children. They'll be worried about, the how high housing is. Now they'll be both a beneficiary of high house prices, but also be worried about their one, two, three, four kids, how they're going to get on the market, and the money that they're going to need. It feels like, I mean, you can see in the numbers how GDP per capita has fallen in Australia. It feels like everything's quite tight here. And maybe if inflation comes down and rates are cut, you can reverse that. But, there's a lot of activity. It doesn't feel like we're certainly not in one of those exuberant moments where, there's huge scope for a massive crash. I don't think you can really see that. The big question is going to be around Nvidia, which was one of the huge drivers of stock market performance around the world last year, in basically every index, every global index, every US index. We'll just have to see. There's only a handful of people making these decisions, right? Satya Nadella, Zuckerberg, Sundar Pichai. They obviously have their own chips. There's probably less than 10 people that are going to determine the fate of Nvidia in the near term. And at the moment, they all want to win. So there's this idea that DeepSeek's come out with a cheap, free model. Does that make these US CEOs more or less competitive? My guess is that it's going to make sure that they're going to really want to make sure that they win this. It's probably spurring them on, if anything. I'm still quite optimistic on that sector, but we have to manage it really carefully on risk. So on Monday, our entire semiconductor position basically went at or below the point, or at the point which we would close it out, and wait for the next upswing. And so we're really right at that pivot point. And then obviously throughout the rest of this week, there's been a strong rebound. So we didn't have to close those positions, but I think that's the right way to do this. I think you have to expect in semiconductors now there's going to be 1 to 2 year cycles or 1 to 3 year cycles, where there's going to be moments of exuberance. There's going to be many future breakthroughs. Demand is certainly going to surprise on the upside. These things are not used at all really by most people, and they will be. And if you can get a good sales agent, I mean, think about the sales function for most organizations. There's somebody there like sending out a ton of emails and like organizing meetings and writing papers and writing blogs that kind of show how the product can be used. Like that's like a high-paying, high-skilled job that is something that an agent could do extremely well. And then once you do, why have one agent? Why not have a large number, covering the whole market? It's not like you can afford 10 salespeople now, 10 people chasing up leads, 10 people generating demand, 10 people following up on inbound. Now you could have as many, like vastly more than that. Which is why it comes back to that software point. It's probably a really good year for software. So it's pretty exciting. I think this is going to be a year for risk management again. And I think it's going to be individual growth opportunities that we'll have to find. We think we've got a couple in the portfolio that we're really excited about. It might be similar to the first half of last year, where there's a handful of companies that do extremely well that aren't really correlated to the semiconductor cycle or the broader economic cycle. Those opportunities are still going to be there, and it's our job to find them. So we're scanning the market, all the companies that are performing well, we're like reviewing, we're seeing if they have that true customer love. And I'm sure the ones that, are capturing the imagination of customers will later capture the imagination of investors. So it's pretty exciting.
Well, that's great. Why don't we wrap up here then?
Okay, sounds good. Thanks so much, Eliana.
Thank you so much. Bye, Mike.
Bye.